Silver's price has been treated less as a signal and more as a tolerance test, a place where stress can be applied without immediately breaking confidence elsewhere. What looks like ordinary volatility often serves a quieter purpose, revealing how much pressure the system can absorb before reactions spill into places that matter more. At the surface, the recent price action looks familiar, even dull to seasoned observers, a series of moves that fit neatly inside historical ranges. Yet beneath that calm exterior, the structure supporting those moves has been thinning, and the market's behavior has begun to change in ways that don't announce themselves loudly. Historically, silver occupies a peculiar position, too small to dominate global capital flows, yet too interconnected to be ignored when something goes wrong. That in-between status makes it useful, not just as a commodity, but as an early warning channel, one that reflects strain before it shows up in larger, more politically sensitive markets. What's different now isn't a single price level or a dramatic breakout, but the way responses to pressure are unfolding. Moves that once triggered predictable reactions are being met with hesitation, as if participants are checking assumptions they used to take for granted. Behind closed doors, institutions don't talk about silver as a bet or a narrative, but as a mechanism. They watch how liquidity behaves, how spreads react under stress, and how quickly confidence returns after disruption, because those behaviors tend to rhyme across markets. The recent sequence suggests that those internal responses are taking longer to normalize, not failing, not collapsing, just lagging, and in markets built on speed and confidence, even small delays can matter more than large price changes. At the institutional level, this kind of lag is often read as a systems check in progress, an informal audit carried out by the market itself. No announcements are made, no rules are rewritten, but everyone involved quietly takes notes. What makes this moment uncomfortable is that the test isn't being administered during a crisis, but during relative calm. Stress appearing early, without an obvious trigger, tends to imply that the source isn't external shock but internal balance. Market behavior implies that participants are probing limits, adjusting exposure not because of headlines, but because the usual signals aren't lining up the way they used to. When that happens in a market as interconnected as silver, the implications rarely stay contained. The price action, in other words, isn't shouting a warning. It's whispering questions about liquidity, trust, and response time, questions that don't need immediate answers to become consequential. And the longer those questions linger without resolution, the more likely it becomes that silver isn't just reflecting stress, but quietly measuring how the rest of the system might react when the pressure finally shifts elsewhere. Liquidity has always been the lifeblood of silver, but the current flow patterns are showing subtle friction. Trading volumes aren't spiking in ways that suggest panic, yet the usual rhythm of absorption and release is altered, hinting at underlying hesitations that could ripple outward. When you track the bids and offers across exchanges, it's apparent that some participants are stepping back just enough to test the depth of the market. This isn't about speculation. It's a cautious assessment of whether the system can maintain function under marginal stress, a quiet experiment in resilience. The way hedging instruments are moving alongside spot prices adds another layer of intrigue. Options activity implies caution rather than conviction, and even modest divergence between futures and physical markets can be a subtle indicator that standard mechanisms aren't operating with their usual efficiency. Reports indicate that settlement patterns are behaving differently as well. Delays that once would have been anomalies are now recurring, and while they haven't caused disruption, they highlight the system's sensitivity to imbalances that historically went unnoticed. For institutions, these patterns are more than noise. They're a diagnostic. Every hesitation, every mismatch becomes a data point in understanding whether the market can sustain the assumptions built into larger positions elsewhere. The implications are technical, yet far-reaching. Even outside of formal channels, participants communicate indirectly through these patterns, testing reactions, adjusting collateral, and mapping vulnerabilities without broadcasting intentions. Observers who miss these cues risk being blindsided when stress finally concentrates. Silver's price action, therefore, isn't just movement. It's a controlled probe, a measure of responsiveness. The market is effectively asking itself how far it can bend before structural behavior shifts in meaningful ways. And that makes the next phase particularly uncertain. If the market has been quietly testing limits, even a small shock could reveal whether the system is merely stretched or approaching a threshold. Positioning is revealing more than outright price changes ever could. Large holders appear to be adjusting exposure incrementally, not to speculate on direction, but to gauge counterparty reactions and the elasticity of the system. Each move is measured, almost surgical, suggesting a market under observation rather than one in chaos. Historical data suggests that when these kinds of adjustments accumulate, they create layers of latent tension. Not every participant is aware of the full picture, yet the aggregate effect alters how quickly liquidity can respond when demand shifts. That lag, subtle as it may seem, is precisely what a system check is designed to uncover. Derivative flows are another lens into this activity. Open interest has not surged dramatically, but the composition of positions hints at hedging and risk transfer strategies being recalibrated. Analysts interpret these patterns not as bullish or bearish signals, but as evidence of underlying market probing. Physical markets reflect this quietly as well. Inventory movement is stable in volume but uneven in timing, suggesting that participants are intentionally pacing deliveries, testing how smoothly supply chains can absorb incremental stress. It's operational observation masquerading as routine trade. The broader implication is that silver is acting as a canary, not for price itself, but for the resilience of interconnected markets. Patterns that would normally be shrugged off are now scrutinized for their ability to reveal friction points before they escalate. Even seemingly minor divergences between paper and physical markets acquire significance in this context. They are signals of structural tension, not speculation, and they prompt institutions to reconsider exposure, margining, and collateral in ways that only insiders can fully parse. At this stage, the market isn't unstable, but it is self-interrogating. Each tick, each settlement delay, each incremental adjustment feeds into an evolving assessment of what stress the system can tolerate. And the tension is cumulative. These small, quiet probes could set the stage for reactions that amplify disproportionately once a more visible trigger appears. Central banks and regulatory observers rarely comment on silver directly, but their frameworks shape how participants interpret pressure. Available data suggests that rules around liquidity coverage, collateral, and settlement windows are influencing behavior more than headlines or macroeconomic releases. Institutions seem to be using these constraints as a backdrop for testing limits. By adjusting positions within the boundaries of regulatory tolerance, they can observe systemic responses without triggering formal alerts. It's a subtle calibration of risk, where the objective is understanding, not profit. Interbank activity reinforces this. Reports indicate that lending and borrowing of silver, while steady in volume, is showing micro fluctuations in timing and terms that wouldn't appear in routine market summaries. These shifts are the sort of signals insiders use to judge resilience and anticipate friction. Currency correlations add another layer. Silver's historical relationships with the dollar, other precious metals, and select commodities are behaving inconsistently, suggesting that the system is absorbing local stress differently than global trends might predict. These deviations, though slight, are enough to catch attention in a market that thrives on predictability. Operational logistics are quietly under the microscope as well. Settlement practices, warehouse receipts, and margin requirements all reflect minor stress points. Each delay or unusual pattern isn't headline making, but collectively, they provide a portrait of system elasticity that few outside institutional circles fully grasp. These nuances create a situation where participants are acting conservatively, not because of fear, but because the market is effectively interrogating itself. Every adjustment, every bid, every hedge is data, feeding into a mental map of how far the structure can stretch. And as this internal testing continues, the tension grows incrementally. The more the system is probed without visible failure, the more latent pressure accumulates. Pressure that could amplify future reactions in ways that are hard to anticipate. Counterparty behavior is now a key focus. Even in the absence of dramatic swings, shifts in willingness to transact reveal hidden stress. When large players hesitate to take on exposure that was previously routine, it signals that assumptions about liquidity and trust are being actively reevaluated. Market signals that once moved in unison are diverging subtly. Futures, options, and physical spreads no longer align as closely as they historically have. These small gaps might seem insignificant to casual observers, but they are the sort of discrepancies that institutional participants monitor for early warnings. The role of algorithmic trading adds another layer of complexity. Automated systems are detecting micropatterns in execution and settlement, but they are designed to react to extremes, not nuanced tests. That means human oversight is increasingly critical to interpret what the machines see, creating a dynamic tension between speed and judgment. Regional differences are also emerging. Activity in certain exchanges shows slightly different liquidity dynamics than in others, implying that localized conditions are feeding back into the broader assessment of systemic resilience. Institutions watch these disparities closely, using them as real-time diagnostics for the global network. Silver's dual identity as a commodity and as a financial instrument amplifies the significance of these subtle shifts. It is not just reflecting pressure, but distributing it across multiple layers of interconnected markets, quietly mapping where friction might concentrate first. Even minor operational delays are instructive. Settlement anomalies, slow responses in warehouse transfers, and discrepancies between physical and paper positions all feed into the broader analysis of system behavior. The market is effectively stress testing itself in plain sight, even if the scale of the test remains modest. And as these signals accumulate, the market's collective attention becomes more acute. Every small deviation carries meaning, hinting at vulnerabilities that are invisible without a careful insider perspective. Sentiment, while rarely expressed overtly in silver, is being inferred from behavior rather than statements. Analysts report that shifts in positioning, even when minimal, are interpreted as markers of confidence, or lack thereof, in the system's ability to function under stress. Data from trading platforms shows that order books are subtly changing. Depth is maintained, yet the pattern of replenishment is uneven, suggesting that participants are testing how quickly liquidity can respond to pressure rather than simply chasing price. Cross-market interactions provide additional insight. Movements in related metals, energy commodities, and currency pairs are not driving silver. Instead, silver is reflecting a broader evaluation of systemic elasticity. Its price action acts as a mirror, hinting at where strain might accumulate elsewhere. This phase is particularly delicate because the signals are quiet and easily missed. Traditional volatility metrics remain low, yet internal checks and balances are being observed in real time, shaping decisions without triggering alarm. Even settlement cycles offer subtle clues. Shifts in timing, partial deliveries, and margin adjustments create a mosaic of operational data that insiders read as a proxy for stress tolerance. These are not crises, they are measured probes. What makes this scenario critical is that small inefficiencies, when aggregated, can magnify in moments of genuine pressure. The system is effectively rehearsing its own response, and every action, hesitation, and adjustment feeds into an evolving map of vulnerability. As these patterns unfold, observers note that the market's behavior is increasingly deliberate. Each tick is scrutinized, each mismatch cataloged, and the cumulative effect is a real-time assessment of systemic robustness that few outside institutional circles fully comprehend. Infrastructure is quietly under examination as well. Custodial arrangements, clearing mechanisms, and inter-exchange flows are all being observed through the lens of stress. While nothing appears broken, the market is effectively testing the seams that hold it together. Reports indicate that participants are adjusting collateral and margin strategies incrementally, not to gain advantage, but to see how quickly counterparties react. These small, deliberate shifts serve as probes into the system's operational resilience, revealing frictions that aren't otherwise visible. Even timing anomalies are significant. Slight delays in settlements or transfers, repeated enough, form patterns that insiders interpret as signals of system sensitivity. Each deviation is cataloged, not as a failure, but as a measure of how much strain the market can tolerate before behavior changes materially. The interplay between physical supply and paper positions continues to reveal tension points. Inventory moves are predictable in volume but inconsistent in cadence, hinting that participants are pacing deliveries strategically to observe absorption capacity without triggering disruptions. Global coordination adds complexity. Silver is simultaneously being monitored by multiple exchanges, central banks, and institutional desks. The system is layered, and probes in one region ripple quietly through the network, allowing observers to compare reactions across jurisdictions and time zones. In effect, silver is acting as a live diagnostic tool. Price alone doesn't tell the story. The system's responses to micropressure, timing discrepancies, and structural shifts do. Each subtle adjustment paints a clearer picture of where latent vulnerabilities reside. And as these internal assessments accumulate, the potential for amplified response grows. Even small perturbations could cascade if latent pressure reaches a critical threshold, making what appears to be routine action anything but ordinary. The final layer of this system check lies in behavioral feedback. traders, analysts, and institutions are all watching each other's responses, interpreting hesitation, pacing, and incremental adjustments as data points. The market becomes both subject and observer at the same time. Positioning is cautious, yet not defensive. Reports suggest that exposure is being tested across multiple instruments simultaneously, futures, options, physical holdings, to gauge how stress propagates through different channels. Each interaction, each reaction, feeds back into a growing map of systemic resilience. Volatility, historically a trigger for reaction, is surprisingly muted. That quiet is telling. The market is absorbing pressure without breaking cadence, but it's doing so while quietly revealing where tension accumulates. Observers note that calm on the surface can mask concentrated stress beneath. Liquidity pathways are under continuous evaluation. Micro changes in order book depth, replenishment patterns, and counterparty willingness are all being interpreted as indicators of how quickly the system could respond if tested further. These signals are nuanced, but the implications are substantial. Cross-asset linkages highlight the subtlety of the test. Silver isn't isolated. It is reflecting, transmitting, and amplifying stress across related markets. The market is simultaneously probing itself and signaling where frictions in the wider system could emerge first. Every incremental adjustment, every timing anomaly, and every pause in typical behavior adds to a composite picture. Participants are effectively stress testing the system without triggering alarms, creating a scenario where the market is both under pressure and observing that pressure in real time. The quiet accumulation of these signals sets the stage for potential tipping points. Silver's role as a systemic indicator becomes clearer. It isn't simply a commodity moving in price, but a barometer of structural and behavioral resilience, quietly mapping vulnerabilities before they manifest elsewhere. And that leaves a question that lingers across all levels of the market. If the system has been probing itself this carefully, how will it respond when a larger, more visible trigger finally arrives? Do you want me to write the conclusion now,